Welcome back, everyone. This week we're going to talk about China and is it time to buy? I've noticed in the last few weeks it seems everybody is talking crap on China. And it actually came to my attention a few days ago. Some podcasts I listened to, they were talking about 4 reasons why China's slowing down or why things aren't looking good, and China this and China that. And my feed was talking about China. And it finally overwhelmed me and saturated my attention sufficiently that I was like, man, everybody's talking bad about China. And it just so happened at the same time, I came across this article or this piece written by Vincent Gave from GavCal Research, which is writes primarily for institutions. We'll get to what he wrote, and the description will be, or the link will be in the descriptions. But it really got me thinking and looking at things and wondering, with all this sentiment, is it overdone? And then sure enough, The Economist comes out with China's delusioned youth, because I heard that they stopped recording, or they're going to stop announcing the Chinese youth unemployment numbers. And then here we have Xi's failing model and riding on a snail dragon. And anybody that might be familiar with contraindicators of the Economist cover actually is the final straw that made me start looking into it this weekend. So coming out today, Sunday, I don't know, August, whatever it is, Chinese authorities made several big announcements today to boost stock market. They have the stamp duty on stock trading. They're tightening IPOs, so that means that the same amount of money can chase less stocks, which means that you can put more support under stocks, because as I've discussed with the dot-com bubble, for instance, or the SPAC bubble, you issue too many companies, and the fools and true believers can't chase all of the companies, so the house of cards kind of collapses. So by tightening the IPO market, money can chase less stocks and thus prop them up better. They're cutting margin financing requirements, I think from 100% to 80%. They're restricting listed companies' refinancing, and they're restricting share reductions by major shareholders, meaning that people can't dump their shares, can't dump large blocks of it, and have large volatile moves as a consequence. So that came out today. Before I started looking into this and thinking about it Friday and then Saturday, and this came out today on Sunday. So here's a few things. Chinese stocks are now... So the other thing that brought it to my attention was how... was it Evergrande is filing now for Chapter 15 bankruptcy protection in the United States. And then, was it City Garden isn't looking too well either. And normally, when you start buying troughs, I would say this is early, by the way. You want some bankruptcies, some good size. You want a big player to get taken out. And we're working our way there, but I can't help but think that it might be too early. But I'm not confident in that estimate. So with that said, let's get into this. Chinese stocks are now underperforming U.S. stocks by the most since 2001. Meanwhile, Chinese high-yield real estate index is down a massive 82% in just over 2 years. This puts the index back down to 2008 levels. Adding to this, Evergrande just filed Chapter 15 bankruptcy, all while China just unexpectedly cut interest rates. Oh, which they cut interest rates recently. Is China on the brink of a credit event? Because, real estate crisis, 2008, people compare it because that's what people do. So is it on the brink of a credit risk and event? I don't know. This is a sentiment and technical analysis trade. So that's how I'm looking at this. China's high-yield real estate index is down 80% and 82%, and it's barely making headlines. I always find that interesting when people say these things. Like, the amount of China information that has come across my screen in the last week seems to reach a feverish pitch. And the problem is sometimes it's for the right reasons. And then sometimes it's just a blip on the radar screen. So that's why when you put on these kinds of trades, these contra-indicator sort of trades, you got to have an entry point, you got to have an exit point, you have to know where you're going to get stopped out at, and so on and so forth. Because sometimes they're actually right. And a Lehman moment is a Lehman moment, and things are going to get much worse before they get better. But a lot of times, it's just people overreacting, so you have to weigh the probabilities on that. Their decision to suddenly and unexpectedly cut rates is no coincidence. It was their biggest rate cut since 2020. Wild times. And then we have this. It'll be interesting to see if the price reversal on the Hang Seng can stick. Single-day reversals have a terrible track record. At least short-term breadth is washed out, and the index rebounded at least 5% every time, though it then failed during the pandemic. So here's a more thorough chart, and you can see 3 months later all these trade dates in which it does this, and you get anything from a 16.98% bounce to a, what's the lowest one? A 2.73% bounce for 3 months, which actually isn't the worst annualized returns. I mean, if you bought all except the 2020 incident, which 3 months later was down nearly 10%, but the 3-month time period, and hopefully you can zoom in on this chart and see what I'm talking about. 3 months at a 2.73% is roughly an 11% annualized return. Now, of course, 6 months later, it's a different story. It's not looking the best. So, just another piece of information to look at. So, we're going to look at a few charts. This is the Hang Seng Index. And you can see my technical analysis here of my red bar across the chart. So we're at quite the support. Does it bounce? Does it bounce a little bit and then fall, capitulate? I don't know. But this would be a good place to potentially put a trade on, which is what I'm looking at doing. With the stock news I shared, I think the second slide, these things are going to probably gap up at the open, and that's going to be irritating to get into that position at that point. So I don't know. I don't know what I'm going to do, to be honest with you. So looks like a really good support spot. So not the worst place for a trade. The Crane Shares CSI China Internet ETF, which is seemingly the one that has a lot of juice to it, that more often than not people talk about, is 4.75% above its initial IPO price from, 2013. So August of 2013 to August of 2023, it is up 4.75%. Now, at one point, it was up a few 100%, and then in 2021, gave it all back. So the question is, you could draw a line across this too and say, well, it's at support. And if you actually look to the right of the screen, you could ask yourself, is this an inverse head and shoulders setting up? I don't know. But yet again, not the worst place to enter. Then you have, if you really want to get into potential degenerate gambling or leverage play, you have the CHIR, which is the Chinese real estate. And that's an interesting chart to look at. That thing's really capitulated, as well as some of the holdings in it. So there's some juice in that. Because real estate news makes everything fall, because it scares everyone, which causes everything to sell off. So really, real estate can still do bad while other things rebound, such as the internet stuff, tech stocks. So I'm not going to participate in a CHIR. And then you have yen, which is YINN, and that's a 3 times leveraged. I'm not sure if it's 3 times leveraged large cap Chinese names or what it is particularly, but that's a good way to juice some returns or lose a lot of money quickly. This is a chart of JD. So here we are, going back to 2016. Quite the support line. Not the prettiest chart either, but if you're into catching falling knives and looking for rebounds and so on and so forth, is it a double bottom? Is it this? I mean, you could do all kinds of pictures. I'm a simple draw a line across the screen kind of person, except in the next chart. So here's more of my beautiful technical analysis, which is you could call this a massive pennant or something like that, and support line. This is PDD, which I actually looked at a few weeks ago because I got bombarded, and I'm sure a lot of you all have as well, with these Temu, T-E-M-U, Temu ads for buying products online for a ridiculously cheap price. And then I was like, who is this and where is this coming from? So I did a little Googling, and sure enough, it was, I forgot the name, Pinduoduo, PDD. Pinduoduo owns Temu, and they seem to be coming up through the ranks of the e-commerce platforms, eating, I don't know, JD's lunch and Alibaba's lunch, or at least gaining market share. I can't say I've researched too much into fundamentals. If you go on some of these valuation websites and look at Alibaba or JD or Pinduoduo, PDD, they get like a B or C ranking. So they're nothing overvalued like they were, say, a couple of years ago, but you got the China risk, which is another reason why these names are selling off, and just all kinds of drama. But anyway, technical chart pattern. Does it break out? Does it break down? Does it trade sideways? Does it retest this little support line, this angled support line that I drew? Again, which means if you enter a position now, you might have to eat a 10% loss before you make a, 20% gain or whatever. Just all things to consider. So this is Gavcal, Gave Vincent, and Vincent gave. And he wrote, in recent weeks, the media have been full of stories about an impending financial crisis in China. Amid all the hyperbole, Gave Vincent wonders why China's financial markets don't seem to be signaling fresh trouble, why Chinese households continue to consume, and why commodities are holding up. And looking at developed world markets, he wonders why more isn't being made about August's collapse in the U.S. Treasury market. Different explanations are possible with very different investment implications. Read the free article. I would recommend all of you read this free article if you're at all interested in China, and maybe even if you're not. You can still broaden your horizon of understanding and read an article that's well written, that offers some good counter arguments and good points and has some charts in it, and develop your thinking. And like I said, the link to this article will be in the description. Now, as a little side note, but in line with what we're talking about, one of the comments to him, or to Gavcal, was, Grapevine told me that new laptop sales are poor, which implies the corporate sector is belt-tightening. This has spillover effects into consumer spending as well. Now, let's stop right there and talk about thinking and how we speak for a moment. This is the, second to last slide. So, it says which implies. We have one more slide to get through, which is another thing that it could imply. It's very interesting that someone says data point implies. It's like you're deriving an ought from an is. I constantly insist that you have to question the concepts in a statement as much as the statement itself. You have to beg the question, what do you mean by implies? And if something implies something, could it not imply something else? And why is it being implied? How is this non-living data point implying anything? How is that possible? Like, are you sure that you're not inferring that? And do you not think that it's a consequence of your perception and how you view the world and how you're biased? Whether you're biased based upon your own conclusive evidence or just the subterfuge of subliminal messaging from the news media? Because I'm sure most people who kind of watch the news have probably a negative bias on China at this moment. I mean, that's what drew my attention to all of this in the first place was, man, everybody's talking, seemingly disproportionately talking about China relative to the amount they normally talk about China, and it's all, for the most part, negative. So not all. For the most part, it's negative sentiment. What's going on? And why all of a sudden? Just like if you remember a couple months ago, all of a sudden, all these news media outlets were talking about the BRICS and the de-dollarization. Like, well, that's been going on for years, decades. Like, why all of a sudden did all the news media outlets, and yet again the podcasts I listen to and Twitter and so on and so forth, why was I overwhelmed with that? You know, here Druckenmiller was going short the dollar and this and that, and it's like all of a sudden dollar this, dollar that. Like, why? And if everybody's positioned on one side, then what does that mean? And there's a quote, I can't think of the quote right now, that what is a consensus that the market's not confirming? Some great trader, investor said that. And it seems like the consensus is China's going bad, but is the market confirming that? And I would say not as much as you might think, which is that article that's linked in the description is talking about. But back to this, which implies, it's like, no, you infer that it's belt tightening. Because, sure enough, Louis Vincent Gave says, I don't think this is anything new. Laptops and PCs are still dealing with the COVID hangover effect. With lockdowns, everyone rushed to buy laptops and PCs, and even bought a spare one to be safe. I know I did. But as a result, no one needs to buy one now, still digesting the 2021-2022 surge. Would thus be reluctant to draw wider conclusions from PC laptop data. COVID messed up the cycle. And he provides his own GavCal's research chart noting China industrial production by products, electrical equipment, electronic computer machines change year over year. And this is the chart. So that's interesting because the reason that, that data point, this data point of laptop sales are poor, implied something, interestingly enough, was a consequence that this person was ignorant or forgetful of the fact of the COVID hangover effect pulling forward demand. You can see that with Whirlpool. You saw it with Home Depot and many of products. Consumer products. So it's like, it's funny that a data point implies something to you, but only implies information that you know. It isn't that you infer something based upon your knowledge set. And that is a distinction with quite the difference. Because what happens is people derive an ought from an is and jump to conclusion. PC and laptop sales are bad because economy bad. Consumers aren't spending much equals bad. Don't buy China. Okay, well, with reductionistic, simplistic thinking like that, not it's bad, what could it mean? It could mean what I just said, or it could mean other things. What other things could it mean? I don't know because I'm not educated enough to know what else it can mean. What other variables am I not considering? And thus not putting it into that context. So this is a different context. So are laptops and PCs not ramping up or not crashing? Is it a consequence of the economy going down the drain, which supports your a priori belief based upon what the media has fed you? because of real estate. So it's this slippery slope of tangentially associated things. It's like real estate's not doing well, therefore banks aren't doing well, therefore government's not doing well because of state-owned enterprises, therefore consumers not doing well, therefore China economy's not doing well, therefore don't buy Chinese stocks. Now, most people will not explicitly and articulately outline it that way. They'll say something like, PC sales bad equals Chinese stocks bad. And then, of course, they'll throw in the Taiwan risk equals me no participate. Now, wording it that way makes them sound stupid, but please believe me, that's how most people think. You know how many people I've talked to who they go on diets and they say, I'm on a keto diet. And then I say, why? And they say, it's low fat, which is interesting because the keto diet actually isn't necessarily a low fat diet, but they think fat bad, keto good. And it's like, well, why do you think fat's bad? Like, aren't omega-3 fatty acids fat? Are those bad? And they're done. Like, they only had a sentence worth of information to give you. Like, they're done after that. Now, at that point, you've called them out, so they were scurry to try to post hoc rationalize stuff, and then they'll start contradicting themselves and getting in all kinds of logical fallacies and nonsense. But that's how people work. So please keep that in mind, because perhaps you could be missing out on this opportunity, having such a simplistic, reductionistic thought of jumping to hasty generalizations and faulty conclusions and deriving an ought from an is due to your ignorance and lack of knowledge set, or failing to factor in and take variables into consideration. So with that out of the way, I'm done with this segment. Now on to my portfolio review. As you will see, this is quite a different looking setup, and that's because it is. I have been with TD Ameritrade, and I switched. This is not Schwab. Schwab, for anyone who doesn't know, Schwab bought TD Ameritrade back in, I think it was 2019, 2021. It was a few years ago, and they're finally integrating people. And, honestly, I'm a little concerned by their behavior, because seemingly they're supposed to give you an email 3 months in advance of switching over, and then give you like a 1 month advance email to let you know what's going on and when your account will switch and so on and so forth. And then allegedly they were supposed to be done by Labor Day, and I've not gotten any emails. And then I started reading into Reddit chats and so on and so forth about other people not getting emails, and how there's speculation and talk about how there actually won't be done integrating until late 2023 to early 2024. And because, as always, these things go over budget and over time, and fair enough. But I don't appreciate that with someone who has my money. So that kind of irritated me. And then I was feeling some anxiety over it. I'm like, I don't have any emails, and they're supposed to give you a link and this and that. And then I'm like, well, what happens if they actually switch me over in Labor Day and I never get an email? They don't contact me or nothing. Like, what am I supposed to do? And then everybody's going to be calling Schwab, because I suspect I'm not the only person, and then I'll have to wait online. And then all of this started stressing me out. So I was like, I kind of Googled best brokerage accounts. I thought about getting an international brokerage account, because that'd be kind of fun. But then their customer service sucks, and so that's what I've heard. I don't want to say any disparaging comments. So I've heard people complain about certain aspects in regards to interactive brokers. And did I call them international brokers? Anyway, so I went with this, and it's different. And allegedly, it'll take 10 to 15 days for them to update and transfer over my cost basis because I don't have that right now for anything, and that's irritating. One of the cool things is that Fidelity pays a lot better interest rate on the cash on hand. My God. That's another thing is why I kind of didn't want to go with Schwab is, well, they pay better interest on cash than TD Ameritrade, but it's still a joke relative to the prevailing interest rates available. So that's why I went with Fidelity. Like, they just put your cash in the Fidelity government money market. And I think that's yielding 4.97. I want to say, like, my God. Like, that's what TD Ameritrade was like 0.01, 0.02. Complete embarrassment. I've not executed any trades with Fidelity yet. There's going to be a whole lot getting used to. Never done business with them. See what happens. And then another thing. So in all of this, I transferred my TD Ameritrade account to Fidelity via Fidelity. So I didn't do it on the TD Ameritrade side. I said, hey, Fidelity, take care of this business for me. Go talk to TD Ameritrade, get my stuff. And then so they did. And TD Ameritrade didn't email me a single time through any and all of this. And it's like, you would think, like, just to make sure, like, hey, man, is this you trying to move your entire account? Not a single email. Like, I find that concerning. And I do believe in keeping constant my comparisons and controlling for variables. And what I mean by this is a lot of people got pissy because, Robinhood refused to let you make a buy order for AMC or GME stocks during that whole fiasco. And so a lot of people left Robinhood. And then they went to Webull. And it's hilarious as hell, which is why these people, are unprofitable traders because they can't keep constant their comparisons and control for variables and consider counterfactuals or factuals. Like, Webull also did that. Like, I'm leaving Robinhood because they wouldn't let me buy GameStop stocks, so I'm going to go to a different broker who also didn't allow people to buy GameStop stocks. It's like, okay. Like, which is funny because that's actually how people are. And to go on a further tangent here, since we're about done, I got to thinking about this a few months ago. And because I actually like to intertwine stocks with life and how the lessons you learn from one discipline actually overlays immensely into the other disciplines. So a lot of people will say, I don't want to date a cheater. Like, say I'm dating you and you cheat on me, I break up with you. And then the reasoning that I cite, my rationality for it, is because you cheated on me. But then I'll say I'm breaking up with you because you cheated on me. And I don't want to be with a cheater. Now that's interesting because then I go on in life and I date a new person. And then say while dating them, maybe the first day in or 6 months in or 6 years in, I found out that they've actually cheated before. I think it's 40% of the population has cheated on someone. So there's a good probability that this will occur. Anyway, and they say, yeah, I cheated on someone. Youthful indiscretion, or maybe it was just the last relationship before you, or before me. So who knows? And that's interesting because, say I'm 6 months in, and they tell me some story about 5 years ago they cheated on someone. And, at that point I should break up with them. But I won't. And most people won't either. And that's interesting because, like, no. Like you said, that you don't want to be with a cheater. But that's not true. See, people, and there's many lessons to learn this. It's not that I don't want to be with a cheater. It's that I don't want to be cheated on. I actually don't mind or don't significantly mind being with a cheater. And then so, it's not that they mind that a brokerage prevented you from buying certain stocks. It's that particular broker. So everything that you abstracted to this degree of morality and ethics and cited reasons for your behavior is all bullshit. It's smoke and mirrors. It's very interesting because you might date someone that makes some kind of transgression or infraction, and then you break up with them. And it's like, well, why did you break? Well, because they did it to you. But it's okay if they did those same behaviors to someone else before you. But I thought it was about the character of the person. It's like, no. It's about the character of the person confined to the subset of their interactions with you. So then all this stuff about morality and ethics all comes into question. And then your commitment to those alleged ethics and principles and ideas and morality comes into question, which is why most people will never bring any of this into question and will just dismiss it and move on. And they'll justify it. Their cognitive dissonance will set in, and they'll post hoc rationalize it, and the interpreter section of their left hemisphere will find a reason to explain it away and feel okay and assuage their insecurities in regard to it and move on, and then don't think about it. And it's just very interesting. Like, it's not that you don't want to be with a cheater, it's that you don't want to be with someone who cheated on you specifically. And that is a distinction with a difference. Anyway, rambled on there. I don't really know. Yet again, uranium did well through the week. I think most of everything else fell. YPF kind of trading in line. I think I'm up a few percent. I think my cost basis is lower, so I think I'm only up a couple of percent. Right now I'm sitting in 32. I kind of do like this function of it. I'm sitting in 32.38% cash. So that hasn't changed. Oh, big update. Did not mean to save this till the end. I am now, oh boy, so here's another fun thing. Okay, I'll say it before I forget. I'm now depositing $50 a week instead of 42. So that comes out to, because, and I don't see that changing, hopefully ever, because I want to keep honest and true to the name of this channel. Otherwise, I might as well change the name of the channel, which is Cup of Coffee Capital. What is the point of that? The point of that is that you and anyone else who is, I don't know, who might want to embark upon investing can do it with small incremental progressions of investing. And it actually adds up, because I think my account now is $1,600 between cash and positions value, has $1,600 value of the account. I started it in January 1st. It still kind of amazes me. $42 added up through all these weeks. We're already at $1,600, or I'm already at $1,600. Like, wow. Like, that could be $1,600 that I alternatively, in another world, counterfactually, would have spent and wouldn't have. So if anything, I've saved up $1,600. I've actually profited. I'm up in my account. I could be down 20% instead of up 20%. So, but I'd still have, $1,400, $1,300. So at this point, $7.14 a day. That's what it is. So cup of coffee. But honestly, look, you can get a cup of coffee, a black, plain, straight cup of coffee at Starbucks, I don't know, $3, $4. But that's not what a lot of people do, which I took into consideration. It was actually kind of lowballing it with the $42 a week. But a lot of people get frappuccinos or cappuccinos or double shot espressos or this or that, and then they spin the little iPad around to you with 15, 25, 20% tip, and then you feel obligated to do that. So when you're out the door, and then since you're there, you might as well get a little croissant or something. So, excuse me for $7.14, because you can say, well, you can go down to your local gas station and get a cup of coffee for $1.09 or whatever it is. I don't know. If I drink coffee, I make it at home. So, Because it could be a pack of cigarettes a day. It could be a 6-pack a day. It could be a lot of things. So I don't think I'm out of line for the $7.14. And I want to stick true to that. Because I kind of wanted to ramp up the money. But it's about an honest person. Well, the trope of an honest, everyday, hardworking American, saving up pennies for their future. That's kind of the vibe I want to put into this. And so I thought about ramping it up to like $100 a week or something. But it's like, that's unrealistic for millions of Americans. And you could say even what I'm doing here is unrealistic for millions of Americans, but it's more realistic. So that's what I'm doing, and I'm going to stick true to that. And I actually been turning it over in my head for a couple of months. Do I want to up it to 50? 50 psychologically satisfying. And I kind of thought to myself, say you were doing this on your own, and you said to yourself, okay, I've created this 8-month track record of outperforming the S&P up to this point, which I have. Maybe I've gained a little bit more confidence, and I'm willing to add a little bit more money to my account. And that would go from $6 a day to $7.14 a day, or whatever I said. And so you get a little confidence and you say, okay, I'm willing to invest another $1 a day in myself. So that's an extra $365 by year end. And that's how I was kind of looking at it. You say, okay, I got this little extra money. Let's give this a try. A few months go by, in this case 8 months, and then you say, you know what, I'm doing well. I'm not doing anything too stupid. And even if I did something stupid, I did it as intelligently as possible, i.e. position sizing. Like if I take on this China trade, I'm going to do it with, no more than 10% of my portfolio, and I can't imagine my stop loss will be more than 20% below. So that's to say that I will lose 20% on 2% of, I will lose 20% of on a 10% position, which is to say that I will lose an overall 2% of my entire portfolio. So that could be doing something stupid, the China trade, but in an intelligent fashion. So losing 2% of your entire portfolio isn't the worst. So you say to yourself 8 months in, okay, I'm confident, I've gained some confidence in my ability, I'm doing well enough. Maybe I'd like to take the next step and up it $1. Now, in all reality, there's constraints. If you're only making $500 a week or $700, whatever your lifestyle calls for, and whether you live in California or in Iowa, makes a big difference to all of this. So at some point, you kind of top out. You can't just add $1 every 6 months. You can't invest $6, at some point, it's more than you'll make. So with that, I don't feel guilty. I kind of felt guilty ramping it up to 50 and 100. I was like, that's just dumb. At that point, I'm just a guy on YouTube showing you my trading account. Because I do know, as I discussed a few times now, that you get penalized if you're not throwing around thousands and tens of the thousands of dollars. And that's what this channel is about too, is not getting discouraged. Yeah, you're playing with small money, $42 a week. Whoop-de-doo. But look where we're at now. Look where I'm at now. $1,600. And we still have months to go in the year. And then you do that for a few years, and then you're compounding your returns. And then soon enough in your life, if you're going to live for any meaningful extended period, which hopefully you will, that money will actually start becoming more and more meaningful. And if you're 20, maybe by the time you're 30, then doing something like this can become a down payment on a home. Or who knows? If you get miraculous returns, it could buy a home. I don't know. But so with that said, it's $50 a week now. I wanted to be transparent and let you know. And with that, with that said, I believe we're done here. So thank you for watching, and until next time.